Higher oil prices are proving headwinds to economies in Europe and Asia, but our featured guest today says there are still some global sectors which can thrive in this environment. Joining us now to discuss is Michael Brown, VP, Director and Portfolio Manager with TD Asset Management. Michael, great to have you back on the program.
Thank you for having me.
It has been an interesting, obviously, 4 or 5 weeks. These soaring oil prices definitely taking their toll on global economies in different ways. Let's start with Europe amid higher energy prices. How are you seeing the market?
Okay, it's a very interesting environment with quite a bit of increased volatility. I mean, as you know, Europe is an energy importer and dependent on quite a bit of oil energy from the Middle East, particularly with no Russian oil and gas coming, or less Russian oil and gas coming in. So the higher energy prices is a headwind to their economy. It increases the risk of stagflation. You've seen this weighing on some of the more cyclical sectors, more energy dependent sectors. Some banks have been weak, as well as some travel related businesses like the airlines and commercial aerospace. However, what you have also seen is some pretty strong performance in the energy names. Now, typically in times of volatility, we choose to look for more enduring trades versus some of these short-term fluctuation trades. So, I mean, you can make a strategy of buying energy when it's low, selling when it's high, going back and forth over a period of days is not our strategy. We choose to look for enduring trades where there's actually an extended period of potential outperformance. Many of these names have been doing quite well, both fundamentally and as stocks going into the conflict, and have continued to do so through the conflict, and we believe for going further out. So.
Okay, let's start breaking down some of the areas that you touched on there briefly. I want to start with perhaps the opportunity in utilities and industrials in Europe.
Mm-hmm. So utilities is a key area that we do like in Europe. I mean, it's a question of, in Europe, renewable energy, improving their energy independence is not a question of just a green initiative. It is a matter of national defense. And so which has been exacerbated by this conflict in Iran. It has shown how much Europe needs to move towards independent energy. Now, that could be renewables, nuclear, or importing LNG. So all of these are quite attractive areas, whether it be gas distribution from the LNG terminals, which ENGIE would be a company that's a leader there, or improving the grid, which could be several industrials feeding into that. One would be ABB or Siemens Energy. There's also, in terms of LNG, there's a company called Gaz Transport, and the name is actually French, Gaz Transport, which they have an exclusive technology for the membranes for LNG cryogenic freezing and transportation. I mean, all of these are benefiting on a secular trend of moving towards reducing energy dependence in Europe. So they were doing well previously, continue to do well. I mean, obviously, the key caveat on these would be the valuation. These are not secrets. So it is watching to make sure that you still have a positive potential return on the stock.
I imagine part of that play, too, no matter how you're generating your electricity, is to strengthen the grid that transmits that. We know in North America we have an old grid. What's the situation in Europe?
I'd say it's a similar underinvested area. They are actively investing in it. Many of these, whether it be construction, engineering, industrial companies like Hochtief or Prysmian that does the cables, are all part of this expansion in the grid improvements. Obviously, the AI data center boom is contributing to the needs here, but it is overall an improved power grid is positive for the economy of Europe as well as their energy sustainability. So.
You mentioned travel and tourism. These stocks have really been sort of battered around over the past several weeks, given what's happening in the Middle East. What's the opportunity here?
I think looking at this, there's been a pretty dramatic sell-off, particularly in almost blanket selling on airlines, as well as hotels, as well as commercial aerospace. I think where we'll be seeing the opportunity will be largely within the commercial aerospace space. As long as the conflict does not go on for an extended period of time, flight hours would continue, benefiting some of the aftermarket, the that are dependent on flight hours. In addition, it's also important to look at where the actual exposures are of these travel-related names. Are they exposed to the Middle East? Are they exposed to North America? Are they exposed to continental Europe? I mean, the higher energy prices, if they stay longer for a longer period of time, could negatively impact travel, or it could change the way people travel. People still go on vacation. It just might be to more local, driving holidays, that sort of thing. So
Okay,
they're
so
still looking.
that's Europe. Let's talk about Japan, because we know that when it comes to the energy crunch that we've seen over the last several weeks, Asian countries are particularly very susceptible to it, very, very sensitive. What's the Japan outlook like?
So first, with Japan, they do have amongst the highest energy inventories in the world. So they have been through this before. They're prepared for this. So short term, there is a cushion. Obviously, if the longer energy prices stay higher as it moves along the futures curve, they do become vulnerable to that. They do, in terms of power generation, have a lot of nuclear capacity. They also, following Fukushima, have a lot of coal capacity as well. So the power generation is there. It might just be at a higher price, or may accelerate the restart of their nuclear generation there. I mean, in terms of Japan, there's still many drivers beyond the energy costs. Some of that would be in terms of the revitalization with Japan, like the construction engineering. We're also seeing in terms of the AI data center trade that is continuing, whether it be semi-cap equipment, or even some of the materials, looking at real asset companies and some of the metals supply chain that come through, or the big five trading houses in Japan, which would be major conduits in terms of international trade, bringing in metals requirements for Japan.
What are the hopes too for that economy in terms of some reform, some stimulus, also sort of helping and supporting the market?
As we talked about last time when I was on here, the current parliament under Takichi is the largest majority in post-war Japan. So they do have the ability to push through fiscal legislation. They do have the ability to control policy, working with the BOJ in concert in terms of managing interest rates, as well as paying close attention to the yen, where yen stability would be key as terms of the rate hikes. There is worries on the yen there. I think that is the greatest risk facing Japan. But really, domestic stimulus, what you're seeing, continued capital reforms that have been going on for a number of years, where concentration on expanding the profitability of businesses, returning capital to shareholders, and really becoming more shareholder friendly as a market overall.